If you're earning a middle-class salary and following the traditional save and wait advice, you aren't building a retirement, you're building a financial prison that you won't be able to escape until it's too late. Today, we are moving beyond basic budgeting and revealing the velocity strategy, the only way to turn a standard paycheck into a multi-million-dollar exit plan. The biggest lie told to the middle class is that a steady job and a modest savings account are enough to guarantee a comfortable future. We've been conditioned to believe that if we just work hard, pay our taxes, and put a few $100s away each month, the magic of compound interest will take care of the rest. But in 2026, the math for the middle class has fundamentally broken. With the rising cost of housing, healthcare, and education, the traditional 10% savings rate is no longer a safety net, it's a recipe for mediocrity. Most people on a middle-class salary find themselves stuck in a mirage. They feel like they are moving forward because their salary increases every year, but their real wealth remains stagnant. They are running on a treadmill that is accelerating faster than they can keep up. This is where the velocity strategy begins. It starts with a brutal realization: you cannot save your way to wealth on a linear income. If your money is just sitting in a bank account or a slow-moving retirement fund, it is dead money. It has no speed, no momentum, and no power to outpace the economic forces working against you. The velocity strategy is about changing the nature of your capital from a static pool to a flowing river. While the average person focuses on the amount they save, the wealthy focus on the velocity of their dollars, how many times that same dollar can be moved, invested, and multiplied in a single year. The middle class is taught to be safe, which usually means being slow. But in a fast-moving economy, slow is dangerous. Being middle class isn't a death sentence for your retirement dreams, but staying in the middle class mindset certainly is. You have to stop viewing your salary as a means to survive and start viewing it as raw fuel for an engine that needs to be jump-started. In this first part, we are breaking the illusion of the steady path and identifying the invisible leaks in your middle-class lifestyle that are draining your momentum before you even start. We are going to look at why your current, safe strategy is actually the riskiest move you can make and how to pivot toward a high-velocity framework that works even if you don't have a six-figure income. The goal isn't just to retire, it's to retire while you still have the health and time to enjoy it. To do that, we have to stop playing by the old rules and start creating a system that generates its own gravity. The core of the velocity strategy is a fundamental shift in how you treat every single rupee or dollar that enters your bank account. The middle class is taught to use money as a one-way street: you earn it, you spend it, and whatever is left over sits in a stagnant savings account. In this traditional model, the velocity of your money is zero. It moves once and then stops. To retire on a middle-class salary, you must transform your money into a multi-lane highway. Velocity is the speed at which your money moves through different assets and returns back to you, ready to be reinvested again. Think of it like this: if you put $1,000 in a savings account at 2% interest, that money is effectively asleep for a year. Its velocity is glacial. However, if you use that same $1,000 to buy a small asset, sell it for a profit, and then immediately reinvest that profit into a second asset, you have increased the velocity. By the end of the year, that original $1,000 might have moved through 4 or 5 different cycles. This is how people with average salaries build extraordinary wealth. They don't necessarily have more money, they just move their money faster than everyone else. The middle-class trap is the park and pray method. People park their money in a mutual fund and pray that 30 years from now, the market will have been kind to them. The velocity strategy, however, requires you to be an active conductor of your capital. You are looking for ways to reduce the idle time of your cash. Every day your money sits doing nothing, it is losing its potential to multiply. On a middle-class salary, you don't have the luxury of waiting decades for slow growth. You need to create a cycle where your money is constantly working, returning to you, and being sent back out into the field. This constant movement creates a snowball effect that far outpaces the linear growth of a standard retirement plan. To start, you must identify your velocity killers. These are the habits or accounts that keep your money stagnant. It might be an overfunded checking account, a low-interest CD, or even equity sitting uselessly in a home you don't plan to sell. To master the velocity strategy, you must learn to hunt for movement opportunities. You aren't just looking for high returns, you are looking for high turnover. The goal is to keep the engine running at all times, making sure that not a single dollar is allowed to stay unemployed for long. The third step in the velocity strategy is mastering lifestyle arbitrage. Most middle-class earners fall into the trap of upgrading their life every time they get a promotion. They buy a slightly bigger house, a slightly newer car, and eat at slightly better restaurants. This is lifestyle creep, and it is the absolute enemy of velocity. Every time you increase your fixed monthly expenses, you are essentially putting a speed limit on your money. You are taking fuel out of your investment engine and throwing it into a furnace of depreciating assets. Lifestyle arbitrage is the art of maintaining a consistent, high-quality standard of living while your income grows, and then funneling 100% of the difference into high-velocity assets. It's about living like you're still on your starting salary even when you've reached the mid-management level. The goal isn't to live in poverty, it's to decouple your happiness from your spending. While the average person uses their middle-class salary to buy the appearance of success, you will use it to buy the reality of freedom. By keeping your expenses low, you create excess capital. This excess is the raw energy that powers your velocity cycles. If you are living paycheck to paycheck, your velocity is zero because you have no capital to move. But if you can create a 30% or 40% gap between what you earn and what you spend, you suddenly have a powerful stream of cash that can be deployed into the market every single month. The middle class often views saving as a sacrifice, but in the velocity strategy, it is seen as a strategic advantage. Every dollar you don't spend on a middle-class status symbol is a soldier you are sending out to bring back 10 more. To win this game, you must become immune to the comparison curse we discussed before. You have to be okay with driving the older car or living in the modest house if it means your money is moving at twice the speed of your neighbors. This arbitrage creates the momentum needed to turn a modest salary into a massive retirement fund. The biggest mistake middle-class earners make is waiting until they have a large amount of money before they start investing. They think, once I have $10,000, then I'll get serious. This waiting period is a velocity killer. In the velocity strategy, we focus on micro-assets, small, high-turnover investments that you can start with just a few $100s. These could be high-yield fractional stocks, small digital assets, or even flipping items in a niche market. The size of the investment matters less than the speed of the cycle. By focusing on micro-assets, you are training your financial muscles to look for opportunities everywhere. You stop being a passive saver and start becoming an active investor. The goal is to take $500, turn it into $600, and then immediately put that $600 back into the next play. This creates compounding velocity. While the average person is waiting for their bank balance to look impressive, you are already completing your third or fourth cycle of growth. This movement keeps your capital productive at all times. Micro-assets allow you to diversify without needing millions. On a middle-class salary, your greatest risk is having your money tied up in one slow-moving place. By spreading smaller amounts across several high-velocity micro-assets, you ensure that some part of your portfolio is always returning cash to you. This constant cashback loop provides the liquidity you need to jump on bigger opportunities as they arise. You aren't just saving for a distant future, you are building a machine that produces results every few weeks. Remember, the middle-class path is slow because it relies on large, institutional systems. The velocity path is fast because it utilizes small, agile movements that you control. By the time the average person finally decides to invest their lump sum, your micro-assets have already doubled through multiple cycles. You are building wealth in the cracks of the economy that others are too lazy to look at. As your middle-class salary grows through raises or side income, you reach a critical junction called the high-speed pivot. Most people use a raise to inflate their lifestyle, but in the velocity strategy, a raise is used to increase the volume of your cycles. This is the moment you transition from microassets to larger, more stable cash flow engines. Instead of just flipping small items or fractional shares, you start looking for assets that offer both high velocity and long-term stability, like small real estate deals or automated online businesses. The pivot is about scaling without losing speed. When you have more capital to deploy, the temptation is to become lazy and just park it in a standard index fund. While index funds have their place, they are low velocity. To maintain your trajectory toward an early retirement, you must ensure that even your larger investments have a high, cash-on-cash return. You want your money to return to you quickly so you can pivot into the next opportunity. You are no longer just looking for growth, you are looking for liquidity and leverage. On a middle-class salary, you use leverage, like a mortgage or a business loan, to move money that isn't even yours yet. This is the ultimate velocity booster. By using the bank's money to acquire an asset that pays for itself, you are moving your own limited capital at an infinite speed. The average person fears debt, but the velocity investor understands that good debt is the turbocharger for a middle-class income. It allows you to control a $200,000 asset with only $20,000 of your own savings. This scaling phase is where the gap between you and the average, middle-class worker becomes a canyon. While they are still saving pennies, you are managing a growing portfolio of assets that move in sync. Your velocity engine is now large enough to start generating its own momentum, requiring less of your daily effort and more of your strategic oversight. You are moving closer to the point where your assets have more velocity than your job ever could. The final stage of the velocity strategy is creating the infinite loop. This is the point where your retirement is no longer a pile of cash that you slowly spend until it hits zero. Instead, your retirement becomes a self-sustaining ecosystem of moving capital. In the traditional middle-class model, you spend 40 years building a nest egg and then pray it lasts until you die. In the velocity model, you build a cash flow machine that replaces your salary entirely, allowing you to retire regardless of your age. The infinite loop works because your assets are moving so fast and generating so much liquidity that you only live off the velocity, the movement and profit, never touching the principle, the engine itself. This is true financial freedom. On a middle-class salary, you achieve this by ensuring every asset you've acquired, whether it's a rental property, a dividend portfolio, or a digital business, is structured to return cash to you monthly. You are no longer waiting for a golden years payout, you are receiving a freedom payout every single 30 days. The beauty of the infinite loop is that it is inflation-proof and recession-resistant. Because your money is constantly being reinvested and moved into the best current opportunities, you aren't stuck with dead investments that lose value over time. You remain agile. While the average retiree is terrified of a market crash, you are confident because your income isn't tied to a single stock price, it's tied to the velocity of your diversified cash streams. You have successfully turned a modest career into an unstoppable financial force. Your middle-class salary was simply the seed. Through velocity, you turned that seed into a forest. The average trap is now behind you because you refuse to be slow, you refuse to be passive, and you refuse to follow a broken script. You didn't just save for retirement, you engineered an exit from the system. Now, the only thing left to do is enjoy the time you've bought back. The strategy is complete, the engine is running, and your future is finally in your own hands. Remember, wealth isn't about how much you make, it's about how fast your money works for you.